Hey there, and welcome to this rapid-fire explainer. Today, we're diving headfirst into the incredibly dramatic 2026 gold market. If you've been watching the markets this year, you already know gold has been an absolute roller coaster. Dizzying highs, sudden gut-wrenching drops, and honestly, a whole lot of mixed signals from the top financial institutions. So we're going to cut right through all that noise. We're looking straight at the hard data from the World Gold Council, JP Morgan, Sprott, and Incrementum to answer the biggest question on every investor's mind right now. Are you buying, selling, or holding?
We're starting right in the thick of the action. Picture this, late January 2026. Gold completely shatters records, crossing a mind-boggling $5,500 an ounce intraday. This wasn't just some minor blip either. It was an explosive surge fueled by really intense, escalating geopolitical risks, specifically heightening tensions between the US and Iran. Investors basically panicked, ran for safety, and pushed the price of gold into completely uncharted territory. For a second there, it really felt like the sky was the limit.
But man, the whiplash was absolutely brutal. Fast forward to late June, and the price had plunged right back down to that critical $4,000 support level. To put that into perspective, according to the In Gold We Trust report by Incrementum, this drop was a massive 27% absolute drawdown from its all-time high. I mean, in March alone, gold recorded its largest absolute monthly decline in history, falling by over $600. If you are holding physical metals or paper gold, this sudden reversal was, frankly, a massive shock to the system.
Okay, so to understand this crazy volatility, we really have to look at the World Gold Council's 4 key macro drivers. Think of these as the forces relentlessly pushing and pulling the price. First up, geopolitics, which, as we just saw, acted as a huge catalyst. Second, Federal Reserve policy and US dollar strength. You know the drill. Higher interest rate expectations strengthen the dollar, which usually acts like a heavyweight on gold. Third, central bank buying trends, a massive baseline support over recent years. And finally, global inflation and oil prices, which pretty much dictate the broader economic anxiety. Right now, these 4 forces are locked in a total standstill.
And this creates a massive tug-of-war. On one side, you've got short-term bearish factors aggressively pulling the price down right now. Things like high US interest rates, cooling central bank buys, and general market deleveraging. But pulling it right back up, undeniable long-term bullish factors. We're talking upcoming US midterm elections, rising industrial demand for precious metals and electric vehicles, structural inflation, and this growing trend of remonetization.
Now, what makes this market so incredibly tricky is just how divided the major institutions are on these exact same factors. Look at Goldman Sachs. They recently lowered their late 2026 target to a more conservative 4,900 ounces because of stagnant interest rates. JP Morgan, on the other hand, highly optimistic. They're targeting $6,000 by year-end and $6,300 for 2027. And then there's Incrementum. They actually already met their baseline target and are now modeling a long-term inflationary scenario of $8,900 an ounce. This massive divide brings us right back to our ultimate question. What exactly should you do?
Let's dive right into option 1, the case to buy. According to Sprott Asset Management, the answer here lies in strategic allocation and historical performance. They've got data showing that if you replace standard bonds and stocks with a specific precious metals allocation, it actually enhanced overall returns over a 20-year period. More specifically, when you compare a standard 60-40 stock and bond portfolio to one that throws physical gold and gold equities into the mix, the one with gold significantly outperformed. Now, they aren't saying to bet the farm on gold, but rather that you make a strategic, permanent allocation.
So the real takeaway for buyers is how you visualize this breakdown. Sprott advocates for an ideal pie of 55% stocks, 30% bonds, and a combined 15% in gold and gold equities. That breaks down to 10% in physical gold as a conservative store value and up to 5% in equities for that extra leverage and growth potential. If you subscribe to this philosophy, you don't look at that recent dip back down to $4,000 as a crisis. No, you see it as a prime accumulation opportunity, a chance to build up that 15% precious metals shield against systemic market risks.
Moving on to option 2, the case to sell and lock in those record gains.
And when we look at localized data, it's pretty obvious why you might want to cash out. As pawnbrokers Suttons and Robertsons pointed out, hitting absolute local currency peaks makes this a highly strategic moment to liquidate. Take the UK, for example. Gold reached an absolutely staggering all-time high of 4,068 pounds per ounce back in early March. If you've got old jewelry gathering dust, scrap gold, or bullion you bought years ago at lower prices, the factual reality is you can cash out today for record local currency values. It's really that simple.
Plus, it's not just retail investors at the local coin shop cashing in. The heavy hitters are doing it too. JP Morgan's data reveals that central banks actually sold 129 tons of gold in just the first quarter of 2026. That was led by a massive 60-ton sale from Turkey in March. Now, sure, some central bank buying goes unreported, but the official momentum has clearly cooled off. If the smartest institutional money in the world has taken some chips off the table during these historic highs, well, it builds a very strong logical case for everyday investors to do the exact same thing.
Finally, let's look at option 3, the case to hold and ride out the volatility. If you check out JP Morgan's latest projections, just holding on makes a ton of sense. Yes, we had that mid-year drop to the $4,100 range, but their analysts forecast a seriously powerful recovery. They expect gold to break out of this current no-man's land and climb back to an average of $6,000 an ounce by the final quarter of 2026. They even see it pushing to $6,300 by the end of 2027. If you think all the macroeconomic risks, like the upcoming elections and sticky inflation, aren't fully priced in yet, holding is exactly how you capture that upcoming surge.
Furthermore, that famous In Gold We Trust report takes an even longer view. Remember, their baseline target of $4,800 for this decade was already hit early in 2026. Now their models are tracking a long-term inflationary scenario that sees the price skyrocketing to an astonishing $8,900 by the end of 2030. Think about that for a second. They don't view the recent 27% drop as a structural weakness at all. Instead, they see it as just a standard feature, a temporary liquidity crisis within a massive ongoing bull market.
And the core idea driving that massive $8,900 prediction? It's a concept called remonetization. Incrementum defines this as the creeping return of gold as a primary monetary reserve asset, happening right alongside eroding confidence in fiat currencies like the US dollar. They argue that holding your gold is absolutely crucial to capitalize on this global transition. If the world keeps shifting its monetary order, they're predicting extreme upward price movements that will make the volatility of 2026 look like a walk in the park.
So there you have it. We've laid out the dramatic trends of the 2026 market, the macro drivers pushing the numbers all over the place, and the very real, factual, institutional cases for all three actions. Buying the dip builds a historical portfolio shield. Selling the peak locks in undeniable, record-breaking cash, and holding positions you for a potential massive global remonetization. Armed with the facts from this explainer, you really have to look at your own portfolio, your own timeline, and your own risk tolerance. So, buy the dip, sell the peak, or hold for the future? What's your next move going to be?